All right, we are 30 minutes into the U.S. trading day on this Thursday, June 13th. Here are the top stories we're following. More evidence of cooling inflation with today's U.S. producer price report, which unexpectedly dropped in May for the most in 7 months. That, of course, is good news for the Fed, which held rates steady at yesterday's meeting. A view from the C-suite. We'll talk about inflationary pressures and the on-the-ground economy with Snap-on CEO Nick Pinchuk, as well as DHL supply chain CEO Oscar de Bach. And Tesla's shareholder vote is shaping up to be a win for Elon Musk, who tweeted that shareholders are backing reapproval of his $56 billion pay package. But is this just a symbolic victory? We'll discuss with Money Stuff columnist Matt Levine. I'm Katie Greifeld in New York. Welcome to Bloomberg Markets. You take a look at markets right now, and interestingly, some of those gains that you saw yesterday and at the trading bell starting to come back a little bit. The S&P 500 still higher, but only to the tune of about 0.1%. Of course, we had a big rally after CPI and then the Fed meeting yesterday, but gains cooling a little bit here. You can see the NASDAQ 100 is the outperformer right now, currently up about 0.8%. Really a healthy margin there to that win. And of course, you have a big winner and a big loser, and that is your small stocks. The small caps currently down about 0.7%. Certainly not feeling the love today. But let's get back to that eco data, because U.S. producer prices unexpectedly declined in May, seeing the biggest dip since October. Here with more is Bloomberg's Mike McKee. And Mike McKee, unexpected more good news for the Fed.
Well, it appears that way, but maybe we're starting to see some possible flaws in that, and that may be why the markets are pulling back a little bit. We did see jobless claims rise, and remember, Jay Powell yesterday said that if jobless claims, or if jobs start to weaken, if the labor market starts to weaken, it could be a reason for a rate cut. Well, here's the thing, though. The same thing happened last year, this exact same week. And so does it hold that jobless claims stay up, or are we going to repeat last year's slide back down after a couple of weeks? That's going to be something to watch. You can't bet yet on the Fed cutting rates because of that. How about cutting rates because of inflation? Well, maybe there as well. Good news on PPI, down 0.2 on the month. A big surprise there. The core flat, and yet take a look at why it fell. This is the ECAN function on the Bloomberg terminal. Get yourself a Bloomberg terminal if you don't have one. If you do, call up ECAN. You can see what happened there. Purple is energy. Almost all of the drop in last month's PPI comes from a fall in oil and energy prices. So does that continue? That's something else to watch. And where do we find ourselves at this point because of all this? Well, as you mentioned, markets are pulling back a little, but basically they're disregarding what the Fed said. Fed's median yesterday, Katie, was for, of course, one cut this year. Markets are pricing in by January of next year more than 2 cuts, 2.5 cuts, basically. So they're looking at 2 this year. We'll see where we end up after we get some more data. Tomorrow, we have inflation expectations in the Michigan survey. So some more stuff to hang your hat on.
Yeah, definitely those inflation expectations closely watched by the markets and by the Fed. And quickly, before I let you go, you touched on a question that's starting to work its way around Wall Street, and that is, when does bad news just become bad news? When do we start actually worrying about growth here?
Well, we'd have to see growth indicators start to fall. Bank of America out with their latest consumer spending report this morning said seems to be holding up very well going into June. People are still spending money. So we'll keep an eye on that. And of course, we'll keep an eye on things like the ISM, et cetera. So far, the Atlanta Fed's GDP Now tracker has us over 3% for the quarter. So not yet is the answer.
Not yet. You heard it here first. Bloomberg's Mike McKee, thank you so much. Let's bring this conversation to the markets right now. We're going to do that with Sophie Lund-Yates. She is Hargreaves Lansdown lead equity analyst. She joins us now. And we'll start, of course, with the macro and with the Fed, because especially if you take a look at the NASDAQ 100, those big tech stocks that you closely track, feels like it has just gone parabolic in the last couple days. And you couch that against the macro environment and maybe all the worrying we did about the Federal Reserve's rate trajectory and their path there, maybe it didn't matter after all when you take a look at the fundamentals.
Hi, great to be back. Yes, I think, to be honest, you've hit the nail on the head there. So much of what we've worried about either hasn't come true. I think we've actually cleared a lot of landmines that the market was really worried about. Things like this huge recession that was apparently around the corner, that hasn't appeared. But at the same time, as you're alluding to there, really what these tech stocks have, they're in their IP, in their margin potential, in their cash flow potential, in their growth potential. It is simply on a scale that hasn't, or certainly wasn't, priced in going into this year. And we are starting to see that play off, of course, particularly surrounding Apple in very recent trading days as they try and more clearly map their AI path. But certainly there is a divergence here between the macro and what tech stocks will do. They are on separate paths, which is not normally a story we tell when it comes to stocks.
And we just heard from Mike McKee that it's not yet the time to ask the question, when do we start to worry about growth? The answer is not yet. But when you take that conversation to the tech sector and you plan ahead, I mean, even if we did start to see the economy start to turn, maybe some of the delayed monetary effects get a little bit ahead of the Fed themselves. I mean, how does tech fare in that environment? Because, I mean, looking at its performance over the past couple of years, it just feels all weather at this point.
Sure. Unfortunately, I do agree. I think we're in a situation where, people will say this is a rising tide that's lifted an awful lot of ships, and not all of those ships deserve to be there. So I do think that as this cycle starts to turn, because we know that it will, that's how this goes, I do think there are going to be some names that are caught out. But what I would say as well is that, particularly if we kind of move to other areas of bigger companies, so if we look at things like the S&P 500, we know, for example, that at the moment we're in this situation where the top 50 stocks in the S&P correlation is at really historically low levels. And that tells me that volatility is doing something quite interesting, but also that gains are cancelling out losses, which is not something that we often see. And I do actually see that we're going to be in that situation for some time to come.
And beyond big tech, I thought this note from your notes was really interesting, that you continue to see margin pressure for retailers at the midpoint of the value chain, but you see continued strengths for the likes of travel stocks and luxury. And that's really interesting because even though we are seeing the pace of inflation cool a bit, the bare fact is that prices are a lot higher at an absolute level than they were a couple years ago. And I've heard that to be bearish, basically, on some of those sectors that you named there. But you're obviously taking the other side of that.
I am. I'm choosing the path of positivity for these sectors. Absolutely. So yes, inflation is high. Yes, I don't think that consumer spending power is completely out of the woods yet, but we only need to look at the absolute strength of some of the sectors. The numbers that we got from Delta, for example, that's just one example. Yes, okay, growth in luxury is slowing, but it's still markedly more resilient than other corners of the market. And actually, I think that means that we've seen some of those valuations return to relatively more attractive areas. But yes, inflation is running hotter than it was a year ago, but that has been achieved without major damage to the economy yet. So that means to me that those corners of the market that are more resilient, I think they'll continue to do so, or be so.
So retailers, maybe a little pressure here, but travel stocks, luxury, it sounds like experiences and, of course, the higher end of the food chain still resilient in the type of backdrop that we're talking about.
Yeah, absolutely. We are in a situation where the categorization of spending has been completely upended. Now, that does mean that there's a little bit of trouble still, I do believe, in food retail, as you're suggesting there. And what I mentioned in my notes is I think that households are redistributing where they're spending. So they're going to try and be stricter with a household budget, but so they can still go on that trip. So they might treat themselves to that more expensive bag or whatever it might be at Christmas time. So yes, I think that it's not a case of everybody winning here, but corners of the market, absolutely, I think still stay incredibly resilient.
All right, Sophie, always great to check in with you. Hope to do it again soon. Our thanks, of course, to Sophie Lund-Yates of Hargreaves Lansdown. Let's take a quick look at what's moving underneath these markets. We're going to do that with Bloomberg's Emily Graffeo. And let's talk about Broadcom having a great day.
Yeah, that's right, Katie. Biggest intraday rise for that stock since March 2020. And it was an all-around earnings beat for the chip supplier. Second quarter revenue and EPS beat, the full year forecast beat, and it was really driven by strong demand for, you guessed it, AI. That's really the theme for the year. And we're seeing that even in June, that is still really causing investors to cheer these earnings reports. This is a company that supplies chips for big tech companies like Apple. But we also saw that they're getting a boost from their integration of a cloud company, VMware. They acquired that company back in November. And all around, when you look at what the street is saying, they're saying that that integration of the company was very successful. We saw Piper Sandler and Barclays both raising price targets on Broadcom, and Barclays specifically saying Broadcom remains one of the best ways to play AI.
And I have to say, Broadcom also planning a 10-for-1 stock split.
That's right.
So hot right now. Tell me about Next Decade. I have to admit, this is not a name that I'm super familiar with.
It wasn't one that I was super familiar with either, but the story caught my eye because this stock is already up 64% year to date. It's a liquefied natural gas company, $2 billion market cap, so kind of on the smaller side. But they signed, or they're planning to sign, a supply deal with Saudi Aramco. Aramco agreed to buy natural gas from Next Decade's planned project in Texas, and this will be the first U.S. purchase deal for the Saudi energy giant. They plan to buy 1.2 million tons of LNG a year, and the contract is looking to be up to 20 years, but they're still working on that being finalized. So we don't talk about energy that much, but it caught my eye. The stock was up as much as 8% in the pre-market, pairing those gains a little bit, but still in the green, Katie.
Yeah, we don't talk about energy because we're so busy talking about AI, but that's a different conversation. Let's talk about Dave & Buster's best ticker play, but it's having a terrible day.
Yeah, when I was listening to your prior guest, you guys were talking about how experiences are somewhat resilient, but it seems like there is some trouble in some food names, and this is definitely one of those. We're seeing those shares down as much as 12%, and it was, you look at the earnings report, a miss on multiple metrics. First quarter revenue, $588 million versus estimates of $615 million. EPS, 99 cents a share versus estimates of 1.76. All around, Truist Securities saying the results were muted by stiff macro headwinds. So I guess less consumers going to these arcade venues and buying the food there. But yeah, I mean, it's a mixed bag when you look at these kind of experience names. Some of them have done really well, and then you have companies like Dave & Buster's that just can't pull it together.
Yeah, definitely a story of have and have-nots. Dave & Buster's shares currently down by the most since September 2022. Emily Grafeo, thank you so much. Now, coming up, Tesla is surging after Elon Musk said that shareholders are backing his $56 billion pay package for the second time. More on Tesla's annual meeting next. This is Bloomberg. Well, Tesla holds its annual meeting this afternoon, and on the agenda, Elon Musk's pay package. Now, Musk said on Twitter that shareholders approved his pay package and that the move to relocate Tesla's legal home from Delaware to Texas has been approved by, quote, wide margins. Here to discuss is Bloomberg Opinion's Matt Levine, also my co-host of the weekly Money Stuff podcast. So we're basically doing the podcast, but on TV, and let's talk about Elon Musk. We talk about him all the time. Obviously, he tweeted the results, the partial but looking like full results earlier. But could anything change between now and this afternoon? What's going to happen, Matt?
I mean, I think he's probably tweeted the results. But yeah, I mean, you can change your vote in a shareholder meeting until kind of the time of the meeting. So it's not completely locked in. And the thing he tweeted was this pretty informal Excel graph, so it's not totally clear that his information is correct. But assuming that it is, then he seems to have enough votes for both proposals.
All right. Does this matter, though? Like, even if the shareholders reapprove this, isn't it just symbolic at this point?
I don't think it's just symbolic. I think you can read a lot of lawyers and law professors saying that it is just symbolic and like there's no legal weight to ratifying this decision. But I'm not really sure that's right. I mean, a judge found that the former shareholder vote wasn't well informed. This shareholder vote is probably a little bit better informed. So you do kind of get another bite at it. They're also still appealing the decision on the pay package. And it may not have that much legal weight, but there is a certain, moral weight to saying, no, the shareholders really want to do this. And why should the Delaware courts get in the way? The reincorporation to Texas is also interesting. I think that this vote is legally binding. I'm not totally sure of that. I think that there has been talk of the possibility of lawsuits in Delaware to keep Tesla in Delaware despite the shareholder vote. But I think that's a little bit of an uphill fight. And I think that probably if they vote to move to Texas, they're moving to Texas.
If they're moving to Texas, that would certainly be interesting as well. A nice reminder that we're talking about a two-prong shareholder vote here. But I do want to talk about the fact that, you've written about the Elon Musk attention auction, basically. And when it comes to his different companies, they're all competing for his attention. And even if, shareholders reapprove this pay package and he doesn't quit in a huff today, which certainly would have been interesting. I mean, it feels like this doesn't necessarily fix the problem of the attention auction, that his attention is clearly divided and he's spending more time on other things than Tesla right now.
Right. I mean, before the judge struck down his pay package earlier this year, he was asking for another giant pay package to keep his attention on Tesla, to make sure that he had a sufficient ownership stake to do AI at Tesla. And that kind of got pushed aside by this package being struck down. But in theory, he could come back next month and say, I need more money, or I need more shares. He needs this stake in Tesla because it's like a big chunk of his liquid wealth and sort of supports a lot of his other activities. But does he need to spend his full time at Tesla? Does he need to focus his artificial intelligence projects at Tesla? I'm not sure, and I'm not sure the pay package changes that.
Okay, so Musk needs Tesla in some very real senses there, but does Tesla need Elon Musk at this point? You think about where this company is. It's a mature car company. It's dealing with mature car company problems. The question is out there, is Elon Musk the proper CEO for this company at this point?
Yeah, I don't know. I mean, I think that there is a real belief among some of the shareholders that this company would be better off kind of getting down to business and not chasing around Cybertrucks and doing other Elon Musk projects. So it is possible that some shareholders out there think that. I don't know. I think if you're voting to approve this pay package, you think the other thing, right? You think that Tesla has an Elon Musk premium, that it is not just a car company, that there's something else going on, and that something else going on is inextricably linked to Elon Musk and his attentions and his ability to come up with new ideas. But I'm not sure that's completely right. And I think that some shareholders have kind of changed their minds on that.
And what is the basis for reapproving the pay package? I mean, there's this idea of fair is fair. It was approved in 2018. He met the metrics. He deserves the money. But if you take a look at the past couple years, the past couple months, he's since unmet those metrics. And it seems hard for me to sort of just block out this history that we know happened.
Well, he hasn't unmet all of the metrics, right? I mean, he was given this pay package when Tesla was like a $50-something billion company, and it seemed highly ambitious to take it to being a $650 billion company. And he did that, and he, well exceeded those metrics. And then, some of that came back, but it's still not at $60 billion, right? It's pretty close to his top target. So, right. I mean, part of it is fair, right? He was given this award in 2018 for the work he was going to do between 2018 and 2022. And the fact that it was taken away, some people feel like he should still get to keep his compensation for that past work. But then the other thing is it's just a question of keeping him happy and keeping him at Tesla. And if you think there is an Elon Musk premium, then disapproving this pay package and having him leave in a huff or otherwise pay less attention to Tesla might be bad for the stock or for the company going forward.
All right, Matt Levine, I'll see you at 1 p.m. today because we record our weekly podcast, which is called, of course, Money Stuff. New episodes out every Friday afternoon. And as you might have guessed, we discuss Wall Street, finance, billionaire pay packages, and other stuff. But let's turn now to the Supreme Court, which is out with opinions today. The High Court preserved full access to a widely used abortion pill. It's a case that, of course, carried major stakes for reproductive rights and election year politics. Joining us now with more is Bloomberg Balance of Power co-host Joe Matthew. So, Joe, set the scene here. What do we know so far?
Yeah, we're talking about a unanimous ruling, which is really something, overturning a federal appeals court ruling that would have barred access, mail order access to the so-called abortion pill, mifepristone. This is something that's become a very big issue on the campaign trail in American politics across the country in the wake of the Supreme Court's ruling that struck down Roe v. Wade. And this really has to do with the lane, the standing in this case. As we read from Justice Brett Kavanaugh, they essentially said that the anti-abortion doctors and organizations who brought this case didn't have standing because there was no harm. They were not directly affected by the law in this case. He wrote the federal courts are the wrong forum for addressing the plaintiff's concerns about the FDA's actions. They could take another path. They said go to Congress, go to the FDA, but not the Supreme Court.
All right, Bloomberg Balance of Power co-host Joe Matthew, thank you for that update. Of course, Joe Matthew and team will have full coverage throughout the day. Still ahead on this program, though, we'll take a look at the companies making the most social buzz today in our Social Climber segment. Up next, this is Bloomberg. All right, it's time now for Social Climbers. A look at the stocks making waves on social media this morning. And first up, Apple isn't paying OpenAI to use its chatbot. Instead, Apple believes that promoting ChatGPT to its users is of equal or greater value than monetary payments, according to people familiar with the matter. Now, separately, Sam Altman told staff that OpenAI is on pace for $3.4 billion of annual revenue. Next up, the GameStop calls that Keith Gill claimed to own traded huge volumes yesterday as the firm's shares dove in the final stretch of trading. While there's no way to tell if he was directly involved, the fear of his exit could weigh on shares, which closed 17% lower. And finally, Wall Street and politics. Donald Trump will meet with executives today as he's increasingly embraced by the business elite. JP Morgan's Jamie Dimon, Citi's Jane Fraser, Bank of America's Brian Moynihan, and Apple's Tim Cook are said to be among those expected to attend. And of course, you can follow all the latest company buzz on TREN Go on your Bloomberg terminal. Meanwhile, you take a look at these markets right now. The S&P 500 actually flipped into negative territory. We're talking about a 0.1% or so lower right now. The Nasdaq 100 still holding on to those gains, but they're not quite as robust as they were just about half an hour ago. Currently still higher by about 0.3%. Meanwhile, small cap losses intensifying. Now coming up, we'll get the C-suite view on the latest inflation read. We're going to speak to Nick Pinchuk of Snap-on and Oscar DeBach of DHL Supply Chain next. This is Bloomberg. Well, we know that U.S. producer prices actually declined for the first time since October. Definitely a surprise, dropping at about 8:30 this morning. Let's talk about that and transition to the C-suite. We're going to do that with Bloomberg's Matt Miller sitting to my left. Matt, how are you?
I'm doing terribly well. How are you?
I am so excited to talk about this. So producer prices, of course, we were expecting a very slight increase, a decline actually. And if you break apart the components, it's a pretty interesting read on the economy.
Well, it's fascinating also that good news continues to be good news, right? I mean, we get a decline in PPI. We also, though, got a jump in initial jobless claims, a jump in continuing claims. Remember last month, the household survey was a little bit disappointing. So we have a deceleration in inflation, but we also may see, because of this, a deceleration in economic growth.
Yeah, I mean, I asked Mike McKee at the top of the hour, can I start to worry about growth? Is now the time? And he told me not yet. But let's actually talk to some executives who run companies who deal with the public. We're going to get the boots on the ground look at how the inflation story is playing out with Nick Pinchuk. He is the CEO of Snap-on. He joins us now. And of course, Snap-on is a manufacturer of high-end tools and equipment. Nick, it's great to have you back with us. Let's start with the PPI, because if you take a look at the components, nearly 60% of the decline was due to gasoline costs. You also saw prices fall for diesel fuel, commercial electric power, and jet fuel. Are your customers seeing those declines?
I don't think they would recognize it as a palpable decline. This is more business as usual. When you're in business, you know, like if you run Snap-on or you're even if you're running a garage, the hits just keep on coming. The prices change all the time. So for us, for example, cold rolled steel is up, hot rolled steel is down, and freight costs. You're going to have DHL on, freight costs are kind of going through the roof. We don't import that much, but ocean freights seem to be pretty high. So you have to manage all of those, but this is sort of everyday business for us. So we don't see any big change.
So no big change, not any that you're feeling and seeing yet. And with that in mind, I mean, I'm curious, you write in your notes that, you're well positioned should we see commercial inflation reignite. And I'm curious how likely of a scenario you see that. And what does well positioned mean here? How do you prepare for that?
Well, we tend to make in the markets where we sell, so we don't have long supply chains, and we tend to be vertically integrated. So Snap-on makes most of its products itself, So that's kind of situation. Plus, when you talk about how we go to market, one of our big components of go to market is right to the end user through our vans or through our direct sales force. So we control the interface with the user and we control the upstream fairly well. So we're kind of balanced for that. The big portion of inflation, I think, here is actually it's about the smaller businesses that are worried more than anybody else. The individuals that are working in the factories and in the garages. I was just with some of them, and they are cash rich. Their businesses are going well, but they are confidence poor and worried about the future.
I have to say, first of all, so I tinker on my motorcycles, and when I can afford to, I always pick up a Snap-on tool. It's like a luxury product for me. If I see the van, I chase it like a kid would with an ice cream truck. But when I go
I can stop it for you. If you'd like it to stop, let me know where you're going to be. I'll have it stop.
Thanks so much, Nick. When I go to, my Ducati dealer, or when I talk to the big car shops around me, they're always having a tough time getting labor. Do you see that slowing down? I mean, do you see those positions filling up? How does the labor market look to you?
Well, the labor market, Snap-on is a little different. You see, we don't have trouble filling jobs because we never laid anybody off in the pandemic. We actually held everybody through the pandemic, even though our volume was down. So people tend to gravitate toward us. We say that, the disadvantage of saying your people are your most important, one of your most important assets are on occasion, you have to act like it. So we try to do that. I do think, though, that there is an ongoing, if you're talking about garages or you're talking about factories, the National Association of Manufacturers say there are today 516,000 jobs open. Before the pandemic, there were 400,000. So that's staying the way it is. Garages are the same thing. There are two reasons for this. One is that finding the skills, upskilling the American workforce. People are going off and studying other things which they can't translate into those technical jobs, whether you're talking about welding in a factory or repairing a car, which is pretty intense idea. Secondly, there's kind of a PR problem behind these jobs. People tend to think of them as dark, dumb, and dirty. They are no longer like that. They tend to think that people who enter those careers are settling for the consolation prize of our society. And this is simply not true. The thing is, when you work in a garage or work in a factory, in a Snap-on factory, but most factories around the world, the NAM will tell you that the average factory worker makes $98,000 a year with benefits. And so you're able to keep your family warm and safe and dry, but you're also able to realize that what you do makes a difference. If you think about it, during the pandemic, when fear was palpable, factories and garages were still working.
Right.
Because what they did was essential. So the essential nature, they don't get paid the most. Patrick McHollins gets paid a lot, but it's not because he's essential. We don't need him. It's because he does something no one else could do. But the people across business that do these technical jobs are essential. And so part of the struggle is to get people trained. Well, first, to get people to believe that these are worthy of an American calling. And secondly, to get them trained. Well, that's the real issue.
But Nick, people will pay also a premium for your products because they are made in America by skilled laborers who really care about their jobs and the product. On the other hand, if I look through, a Home Depot, or if I scroll through Amazon, seemingly everything is made in China. So while you've always produced here, it doesn't seem like anyone else has brought that much manufacturing back. Do you see that from your peers?
Well, I'll tell you this, the National Association of Manufacturers, I was just in Washington with them. And here's the issue, is that in the supply chain problems were the children of the pandemic. We had a lot of problems and became clear we wanted to bring things back. Manufacturers were all ready to bring things back. But what happened was, even though the governments, whatever administration, I'm not talking about a particular administration, but generally, if you look at the current one, I will talk about this one. Okay, we have the CHIPS Act, we have the infrastructure, great things, but they don't recognize the broad value of manufacturing. So manufacturers, particularly the small ones, are sitting there saying, well, should I expand? Should I hire more people? Well, we got an election coming up, and you're wondering what the policy is going to be. It's not enough, people are talking about, okay, for those guys, just those small manufacturers, let's raise the individual rates. And the 199A exclusion, deduction for small manufacturers is going to go away. So their prices will go, their costs will go up. They're already paying, according to the NOM, $50,000 per employee in regulation costs. And so they're saying, gee, does America really want manufacturing? It's not just saying I like manufacturing, or I endorse it. When push comes to shove, they actually have to support it without sacrificing the interest of manufacturing, this great endeavor on the altar of other things. And small manufacturers, when you look at their outlooks, are very low. And part of it is because of this.
Well, Nick, I really only have a minute left with you, and I really want to get this question in. I want to talk about auto technicians here, because taking a look at your last earnings release, there was that concern there that maybe the technician audience that you have is starting to pull back here. And I'm curious, if that's the case, what's the catalyst to bring that demand back?
Well, I think some of these things, first of all, they're as I said, the garages are filled. I was just in garages last Friday. So the garages are filled. They have cash. But what they're doing is they're seeing the inflation, and they're seeing that milk is still 31% above pre-pandemic levels. They're hearing about the wars. They're not paying attention to the Fed. They don't pay attention to the man behind the curtain. But they're thinking about wars. They're hearing about the border. It's a migration. They're worried about China, and they're worried about the outcome of the election, what's going to happen. And so those things, they will either have to get used to the inflation, or those things will have to be resolved. What's happening to the technicians is they're still buying, but they're buying shorter payback items, like a hand tool behind me. So they can say, look, I don't know what's going to happen in 15 weeks or 3 months, but I'm sure I can pay for that time. I'm going to buy as much of those that I want. But they're not buying the big boxes behind me because it'll take them longer to pay that off. We've seen this before in the great financial crisis. Anytime things get uncertain, that's what happens with the people of work.
Right. Nick, unfortunately, have to leave it there. Hope to have you back on soon. Feels like every time we're just getting started. Nick Pinchuk of Snap-on, thank you so much. And for another take on inflation, joining us now, I'm pleased to say we have Oscar de Bach. He is the CEO of DHL Supply Chain, of course, a leader in global logistics. And I want to bring you something that Nick just told us, and that's that freight costs are going through the roof. And you also see container shipping rates still climbing here. What's your outlook? How long will this last?
Well, I think that's always difficult to exactly forecast. But I think what is interesting to see is indeed the freight rates are obviously high, and that's obviously a factor. Although it's good to see that now with the PPI you just presented, that the service cost is actually flat. So that's no longer a cause for price increases. So it's good to see that starts to gradually stabilize. The other element which I think is good to see is that inbound volumes are specifically ocean freight volumes are increasing, have been increasing over a while. So that's also good to see, because that means that's the inbound volume into the economy. So I think that's another positive indicator. So, and you start to see that our customers start to gradually build up their stocks carefully. And also building on the point that was made with the earlier speaker, but they're carefully building up their stocks in order to be prepared to let's say a decent peak in Q3, Q4.
I wonder about the freight costs. If I look at the Baltic dry average, we've come what looks like back to normal, slightly elevated, but nothing compared to the pandemic, Oscar. How much are we looking at just a normal freight cost right now, or how elevated is it?
Yeah, it's difficult to say what is normal and what is not normal. What I think is that at least those ridiculous jumps that were there in the past, ups and downs, I think we sort of start to see that gradually that starts to stabilize. And I think what is most important with those rates is that you start to get that they become more predictable, so that companies can build their cases on it, can forecast on that basis, and can price on that basis. And I think we're getting gradually more into that situation.
And Oscar, I'm curious to hear your thoughts on what you're seeing when it comes to onshoring and nearshoring. Like Matt mentioned in our previous conversation, a lot of companies talked a big game coming out of the pandemic that they were going to bring some of their manufacturing and their supply chains closer to home. You haven't necessarily seen as much of it as you might have thought. What are you seeing from your clients when it comes to that impulse?
Yeah, what you clearly see is, and as you know, as I call it, is omnishoring. Because what you see that customers do is that they no longer going to bet at one single market for their strategic components. So they'll make sure that they actually have that from at least two markets to come in from, so that you're never exposed to whatever is going to happen in the near future in the supply chain. And that's actually a trend that you clearly see. So that doesn't mean that they move away from where they were before, but it actually means that their future investments, their next capacity increase of production, they'll make sure that they will do that in a separate market than when they were before. And obviously that would be near to their main markets. So we've seen major growth in Mexico. We've seen major growth in Malaysia. We've seen in the rest of Southeast Asia. We see major growth in countries like India as well, but also to countries close to Europe, like for instance in Turkey and recently also Morocco. So you start to see that trend is happening. Obviously, it doesn't simply happen in a few months' time, right? That is gradually evolving. But what we see is that whatever we've invested in Mexico, whatever we've invested in Malaysia, it fills up right away.
And it's a good perspective there, too, that we're talking about a longer time frame. It's not going to happen overnight. You mentioned some of the countries that are benefiting from that push, Mexico among them. But I'm curious whether your clients are running into any issues that maybe they didn't foresee when it comes to nearshoring, onshoring, omnishoring, as you say.
I mean, the issues that you run into is it's always a capacity game, right? The capacity, it starts obviously with capacity of real estate, but it also is the capacity of attracting people, attracting talented people that actually can do the job. It is also the limitation of some of the infrastructures, because of some of the markets that I mentioned, there are also a limitation of the actual infrastructure in those markets to be able to carry those increased volumes going forward. So those are challenges. We're obviously trying to help our customers as much as possible with, on the one hand, investments in buildings, but on the other hand, also making sure that we have people available, well-trained people available to do those jobs. And on the other hand, what is really important is the investments in digitalization, being collaborative robotics, being having more visibility of data, having more AI or generative AI in order to make sure that you can better forecast your supply chain, and on that basis better forecast your capacity need, therefore your people, therefore your building, therefore your trucks. So the better you can manage capacity, the better you can also handle the scarcity of resources.
All right, Oscar, always great to speak with you. Really appreciate your time. Our thanks to Oscar de Bach of DHL Supply Chain. And Matt, thank you too for joining me. We should do this more often.
It's been a pleasure. Yeah, we should get together and maybe we should start our own show.
Yeah, maybe in July. We'll see. Anyway, coming up, what happens when failure isn't an option? That's what Ruchir Sharma explores in his new book, What Went Wrong with Capitalism. Wall Street Week is next. This is Bloomberg. Well, it's time now for our daily Wall Street Week conversation. And since the Great Depression, the U.S. government has stepped in to prevent economic and financial fallout from private sector failures. Ruchir Sharma, author of the new book, What Went Wrong with Capitalism, sat down with Wall Street Week's David Weston to talk about whether the government is doing too much rescuing.
On one hand, you have like all this great data that the American economy is relatively resilient. But if you look at the number of people who are happy in America with the state of the economic union, it is at close to record lows according to many polls. There are about 7 in 10 Americans today who want the major change to the economic system, or in the language of the polls, have it completely toned down. That's pretty dramatic. There are only about 35% or so Americans today who feel that they're going to be better off than their parents. 50, 60 years ago, about 70, 80% of Americans felt that they're going to be better off than their parents. So there's a real feeling that something has gone wrong. And I think that it's particularly the fact to do with capitalism, that most young Democrats, in particular in America today, say they would rather have socialism than have capitalism. Now, that's such a big statement for this beacon of American capitalism and all that we've spoken about, of global capitalism rather. They are saying that they would rather have socialism, a large cohort of the millennials and the young people, rather than have capitalism. So something has gone wrong. And what I've done in this book is to sort of look at deep down what's gone wrong. Because, as they say, the first step to a cure is to first diagnose the problem. But I feel that in America today, we're not even diagnosing what the underlying problem is.
Why does it make sense, from your point of view, having studied this now, if you didn't know anything about our society, if you didn't read any of the media, you didn't read any of the polls, and you looked at our growth rate, which is at or above historical trend lines, and you looked at unemployment, which is close to lows of all time, most indications would say this should be a pretty happy economy. So why is it not?
Exactly. So, because after I said that there's a sliver at the top which is doing very well, but we have this two-track economy out here that even now, if you look at it, the bottom 50 to 60%, they don't have any excess savings. They're not being able to spend that much. And as I said, that there's a feeling that they're being squashed by what's happening at the top, that today in America, economic mobility, social mobility, all have declined significantly. Like, this is a country where people would move around a lot, or people would be in search of an opportunity. As I said, there's a real feeling in America today that they don't have equality of opportunity. And I think that, yes, at the top, things look very good. The stock market's doing great. The likes of NVIDIA are barring the entire stock markets of the world, if not just the US. But I think that deep down, there are some very key societal issues. And that's what I've tried to examine in the book, that what's really happening. Because at the end of the day, if you look at the trend over the last 30 to 40 years, our trend growth rate is slowing down. Productivity growth rate is slowing down. And at the same time, inequality is rising. And you're right that at the surface, growth appears okay. But a lot of Americans today, their trust in the government is also at record lows. So they know growth is well, but they know that growth is also being funded a lot by an increasing amount of debt. And their faith that the American government will be able to do something about that and to have their future determined by the American government, that leaves people in a very perilous state. That can we really trust the government to make good on their obligations and their promises when they have got so much debt? So even though the economic growth is okay, as I said, economic and social mobility today is at record lows.
Is it the government's fault in this sense? 2008, 2009, we had the great financial crisis. There was concern about a depression, not just a great recession, but a depression. And there was a lot of government intervention, both on the monetary side and the fiscal side. A lot of people thought that was necessary to save us and maybe the world from depression. Then you had a pandemic, and we brought the economy to a stop. And again, it was thought there needed to be a lot of stimulus. Was it the government's fault? Didn't they need to come in and have this level of stimulus and support?
Yeah, as I say in the book, that when we have a crisis, I can understand that the government needs to intervene. I'm not a kind of person who's a liquidationist, that you just let things sort of go and melt away on its own. What I've shown in the book is just look at the progression of capitalism over the last 100 years. We have gone from this liquidationist argument, which caused the Great Depression in the 1930s, to now an impulse where you liquefy. That the moment you have even the slightest crisis, like you had last year with the SVB or something, the impulse is that we got to intervene, we got to save. And the problem is that we only have one case point, which is what we use all the time to justify intervention, which is that we think if we don't intervene, we'll have another Great Depression.
All right, let's take a look at these markets right now, because we're seeing a complete reversal of yesterday's action. You can see the S&P 500 lower on the day. Big tech is your outperformer, up about 0.4%. And small caps, yesterday's winner, now today's biggest loser. The Russell 2000 down about 1.1%. We'll continue to follow that. Coming up, Bloomberg Technology. That does it for Bloomberg Markets. I'm Katie Greifeld, and this is Bloomberg.